Well, now let's move on to our next issue for property, plant, and equipment. And that is, once you've determined the acquisition cost for property, plant, and equipment, how do you account for the use of that asset? How do you allocate the cost of that asset to expense over time? Well, this is an application of the matching principle. The portion of the acquisition cost that's used up in each accounting period should be expensed or matched against the revenues that that asset helped to generate. For property, plant, and equipment type assets, we call that expense depreciation expense, as you've already seen previously. If we're talking about the utilization of natural resources, we call that expense depletion expense. And as you'll see shortly, when we use up intangible assets over time, we call that expense amortization expense. So these three things are all just different terms that mean the same thing. They all represent the allocation of the cost of an operating asset to expense over time. In the case of property, plant, and equipment, it's difficult to know with any precision just how much of a machine or a building, just what portion of the utility of that asset you've actually used up in a given accounting period. So GAAP permits the use of really any reasonable method of depreciation. That said, there's several standard approaches that companies use. By far the most common is the one you've seen already, the straight line method of depreciation. I also want to introduce you to a couple of other options, the declining balance method and the units of production method. Regardless of which method we use to compute the amount of expense we take each year, the accounting effect of recording depreciation expense is always the same thing. It always looks basically like this. You record depreciation expense. Because it's an expense, it reduces retained earnings, reducing equity of the business, and simultaneously the other side of the entry is to reduce your assets by crediting or increasing the contra asset account accumulated depreciation. Because accumulated depreciation is a contra asset account and we're listing it on the asset side of the equation here, we need to show it as a negative amount. So the effect of recording depreciation expense is to decrease assets and decrease equity. Let's take a quick look at some important terms as far as depreciation goes. Residual value or salvage value is the amount that a company thinks it can sell an asset for at the end of its useful life. Residual value is estimated by management when it purchases an asset. Depreciable cost of an asset is the acquisition cost of the asset, as we talked about earlier, minus that residual value. So depreciable cost is the maximum amount of depreciation expense a company can take over the life of that asset. We depreciate assets over their useful life. Useful life is generally measured in time, but it can also be measured in units of output. Note that this is also an estimate that management needs to make. And finally, and a very important term for us is net book value, also often referred to just as book value. Net book value is acquisition cost of an asset, so what's in the asset account in the company's general ledger, minus the amount of accumulated depreciation on that same asset. Net book value is the balance sheet presentation of property, plant, and equipment, and this term is also important in helping us compute depreciation under the accelerated method, and it's also important for us in trying to compute gains and losses, so keep that definition in mind. Well, now let's review the straight line method of depreciation, which I hope is already familiar to you. If you're computing straight line depreciation for a year, this is how you would do the computation of the annual amount of expense. In the numerator, you have depreciable cost. Remember, depreciable cost is acquisition cost minus residual value. Those are divided by estimated useful life, and if you're computing depreciation annually, it would be estimated life in years. Straight line depreciation is by far the most commonly used method, and I think it's because it's the most intuitive and the easiest method to apply. One reason it's easy is that it basically results in the same amount of depreciation expense each year. Let's do an example. These are the facts that we'll use for illustrating several different methods of depreciation. It's January 1st, so to simplify, we're going to purchase this asset at the beginning of an accounting period. Company buys a truck, PP&E, for $15,000. They estimate a residual value of $3,000, and they estimate a useful life of 5 years. How would we do depreciation expense on that truck? Well, fill in the formula that you saw earlier. Acquisition cost is $15,000 minus residual value. Depreciable cost is $12,000 divided by 5. Depreciation expense in year 1 is computed simply at $2,400. A company keeps track of the cost of that asset in its general ledger account. General ledger account generally just has totals. Companies also keep what we call subsidiary ledgers so that they know the makeup, that they know how many assets and what they each cost for purposes of doing things like computing depreciation expense. A basic depreciation schedule could look like this for one particular asset. We've taken $2,400 of depreciation expense in year 1. Accumulated depreciation at the end of year 1 would also be $2,400, and this column is net book value. Book value of the asset is cost of $15,000 minus accumulated depreciation of $2,400. Now, what about year 2? How much depreciation expense would we record then? Well, let's fill out the rest of that schedule. Here's the whole thing. In year 2 and in every year, that's what's so nice about the straight line method, as long as you have a full year, you'll take the same amount of depreciation in each year. Notice that accumulated depreciation grows by $2,400 each year, and correspondingly, book value decreases by $2,400 each year. In each year, I could get book value by taking cost minus accumulated depreciation, or I could take last year's book value minus the current year's depreciation expense. Either approach gets me to the same number. Notice also that at the end of the useful life of this asset, accumulated depreciation will be equal to the depreciable cost of the asset. That needs to always be the case no matter what method a company is using. And, by the same token, the book value of the asset will always be equal to the residual value of the asset at the end of its useful life. This would be the balance sheet presentation for this truck at the end of its useful life. You can see that by utilizing an accumulated depreciation account, a reader of the financial statements would have more complete information than if all they saw was just the $3,000 book value of the asset. With this presentation, they have an indication of what the original cost of the asset was, and because they see accumulated depreciation, they get some sense as to how old the asset is because they can see what percentage of the cost has been used up. The asset would just stay on the books at $3,000 until it's actually sold. Most companies who fully utilize their assets just set a residual value of 0, and eventually they just abandon those assets when they no longer have a use for them. I'd like to show you just one variation, one possibility for an accelerated depreciation method, just so that you can get a sense of how they differ from straight line depreciation. Accelerated depreciation methods are actually the underlying depreciation method that's used by the IRS. So most businesses are in fact using accelerated depreciation methods for tax purposes. The idea behind an accelerated depreciation method is that you take more depreciation expense in the early years of an asset's life and less depreciation expense in the later years. What kind of theoretical justification would we have for doing that? Well, there's a couple of reasons that you could argue that it makes some sense. Basically, with an accelerated method, we're matching the higher depreciation expense with what's possibly the higher revenues being generated by that asset in the early years of its life. In the early years of an asset's life, it's less likely to be needing repairs or be sitting there broken down waiting for a new part, etc. And in addition, we could argue that an accelerated method actually maintains a more uniform total use expense for a given asset. Because remember, the cost of an asset is more than just its acquisition cost. The cost of an asset also would include ongoing repair costs for that asset. So since repair costs are generally lowest in the early years, you are reporting that along with your highest depreciation expense. And then in the later years, you're reporting the lower depreciation numbers and the higher repair expense numbers. So for the same asset, you're actually reporting a more uniform total cost. Well, let's take a look at how we would actually apply one of these methods. And the method that I want you to understand would be what's called a declining balance method, and in particular I'm going to teach you a variant of the declining balance method called double declining balance, because it's one that's very commonly used. Under a declining balance depreciation method, you basically use this formula to compute your current year's depreciation expense. You take the current net book value of your asset, and remember, net book value changes all of the time. It's always getting lower because it's cost minus accumulated depreciation. So the formula is always take your book value of your asset times this declining balance rate. And in the case of double declining balance, the declining balance rate is computed as twice the straight line rate. That's where the name double declining balance comes from. So you compute your double declining balance rate, and each year you use that same rate by multiplying it by the book value of the asset, and that gives you your depreciation expense. Because book value is cost minus accumulated depreciation and it ignores residual value, this method basically ignores residual value in its annual computation. However, you still need to stop taking depreciation expense when your book value is equal to your residual value. Let's take a look at how we compute this double declining balance rate. Here's how you get the straight line rate. It's easy. You basically take 100% and you divide by how many years of useful life you're predicting. So for an asset with a 5-year useful life, the straight line rate is 100% divided by 5, or 20%. If you're using the double declining balance method, you double that, and the DDB rate is 40%. If instead your asset has an 8-year life, the straight line rate is 100 divided by 8, double that, and the DDB rate, the rate that you multiply by net book value, would instead be 25%. So the double declining balance rate depends on the useful life of the asset. Let's do some computations to illustrate this. Here we're using our original story for that truck. If you recall, we bought the truck on January 1st. We paid $15,000 for it. It had a $3,000 estimated residual value, but notice that's not part of my computation here at all. And it had an estimated useful life of 5 years. So for that truck, here's how we do the computation of depreciation expense in year 1. First of all, we take the current net book value of the truck, which would equal, in year 1, the acquisition cost. We multiply it by the DDB rate. The DDB rate is the straight line rate times 2, or, since it's a 5-year asset, 40%. So in year 1, we're going to take $15,000 times 40% as our depreciation expense. As you recall, with straight line depreciation, the same number was $2,400, so you can see it makes a large difference when we switch to DDB. Also notice that this isn't twice the straight line depreciation. We have a different computation going on here because we have not used residual value in this computation. So this is actually more than twice the straight line amount. We use twice the straight line rate, but we're applying it to a different base, so it's not twice the straight line depreciation. At the end of year 1, The new book value of our truck is $9,000. So use that to compute the depreciation expense for year 2. How are you going to do it? Well, now in year 2, you'll take your book value of $9,000 and you'll multiply it by that same DDB rate, 40%. In year 2, depreciation expense would be $3,600. So if we complete line 2 of our schedule, you'll see that at the end of year 2, book value is now $5,400. You use that number to compute $2,160 of depreciation expense in year 3, and at that point book value has dropped to $3,240. But look what happens in year 4. In year 4, if you do your standard computation, you get depreciation expense of $1,296. But I haven't taken $1,296 of depreciation because when I put that number in my schedule, my accumulated depreciation exceeded $12,000 and my book value dropped below $3,000, and I knew I couldn't do that. This is where you do take into account residual value under the declining balance methods. So in year 4, I'm limited to taking only $240 worth of depreciation, and in year 5, I'm actually limited to 0. Under a declining balance method, you may end up needing to stop taking depreciation early, or you may actually end up with a larger deduction in year 5 than you did in year 4, just so that you reach the correct book value by the end of the asset's useful life. In general, though, what we see is what you would expect by the name. This is an accelerated method, so we see higher deductions in the early years, lower deductions in the later years. And as with every method, by the end of the asset's useful life, accumulated depreciation will equal depreciable cost, and book value will equal residual value. Well, now let's take a look at one more type of depreciation method because it's fairly different. Often called the units of production method, this is also commonly known as an activity method. This is actually really similar to a straight line method, and the main difference is that instead of estimating the useful life of your asset in years, you estimate the useful life in some sort of unit of production. So basically, instead of calculating a cost per year, you're calculating a depreciation cost per something, per item manufactured by a machine, per mile driven on a car, per hour of use on a computer monitor, something like that. So the computation, the formula, looks a lot like the straight line formula. Basically, you're taking your depreciable cost, acquisition cost minus residual value, and you're dividing by an estimated life in units. So you're going to have a cost per unit. To convert that to a cost for a given accounting period, you need to multiply that by the units used in each accounting period. And this is actually a lot more intuitive than it sounds if we apply some numbers here. Let's think back to our truck example that we've been using. Remember, the cost was $15,000, the residual value was $3,000, and we had estimated the useful life in years to be 5. Under this method, we need to think of a way in which we can determine another way in which we can measure the useful life of this type of asset. And since it's a truck, it would make sense to do it in miles driven. So we're going to estimate the life of our truck to be 100,000 miles. We know that in year 1, it was driven 30,000 miles, and in year 2, it was driven 20,000 miles. Let's compute depreciation for years 1 and 2 under the units of production method. Our depreciable rate would be our cost of $12,000 divided by our estimated useful life in miles, 100,000, or 12 cents a mile. In other words, for every mile we drive this truck, we're going to charge 12 cents of depreciation expense. What's our expense for year 1? Well, how many miles did we drive in year 1? 12 cents times 30,000 miles driven would be $3,600 of depreciation expense in year 1. Similar logic in year 2 yields $2,400 of depreciation expense there. This method seems to be a really good application of the matching principle because we're more closely tying asset use to depreciation expense taken. Alright, well, so far in our examples, we've only looked at assets where you purchase the asset the first day of the accounting period, and so we've taken depreciation for a full year in the three different methods that I've illustrated. Whenever you own an asset for less than a full year, you need to do a short year proration of depreciation expense, and we've already seen examples of that way early on in the course. So we only record depreciation for that portion of the accounting period when you actually owned the asset. Usually you have a short year proration both in the year of acquisition and in the year of disposition. In general, there's all sorts of rules of thumb companies can use so that they can make these computations more easily, but the way we'll generally do it is we'll just base depreciation for a short year on the number of months ownership, and we'll just round to the nearest month. You need to prorate both straight line and double declining balance computations by simply taking your annual depreciation and multiplying it by 3 over 12 or 6 over 12, however many months you own the asset in the year of acquisition or year of disposition. Units of production depreciation expense is not prorated because your depreciation expense isn't based on time owned or time used. It's instead based on units driven or units produced during that accounting period. Let's consider very briefly tax laws for depreciation. Companies generally use different rules for financial reporting depreciation than they use for tax depreciation. Small companies may actually use their same tax depreciation schedules and use those same numbers on their financial statements just because they don't have the accounting staff to maintain two sets of depreciation records. But most larger companies use generally straight line for financial reporting purposes, and then they use the method required by the IRS for their tax depreciation. Tax laws use what's called MACRS or Maker's Depreciation. They generally assign different types of assets to a useful life or a category, and you look up depreciation expense based on a table for that category. Those tables are based on double declining balance or 150% declining balance methods. And finally, a quick review of why a company might choose one depreciation method for financial reporting purposes over another. As we've said, straight line is generally preferred just because it's so simple. The choice of a depreciation method might affect things like loan covenants, because often loan covenants require certain financial statement ratios or certain levels of net income. And the choice might also affect things like compensation if your compensation agreements are based on financial reporting net income. But in general, the choice of methods for depreciation does not affect cash. Remember that depreciation is not a source of cash or a use of cash, and companies have complete freedom to use different methods of depreciation for financial reporting purposes than they use for tax purposes.